Good morning, everyone, and welcome to the Hawkinston Smith Autumn Statement 2002 webinar. My name is Nick Blundell. I'm a tax partner here at MKS, and I've been joined by my colleague, Claire Roberts, who is also a tax partner here with me at MKS. We're going to go through everything that the Chancellor talked about last week, and we're going to do it in about 45 minutes. We hope to wrap up in. And if you've got any questions, could I ask you to use the Q&A function on Zoom rather than dropping it in the chat, and myself and Claire will try and answer them as they come up, or as we go along. We're going to go through personal taxes, corporate taxes, VAT and employment taxes. There was quite a lot of announcements last week, particularly across personal taxes, and lesser amount in some of the other areas, but we'll touch on everything. Well, as everyone knows, it's been a busy year for politics, and particularly for Chancellors of the Exchequer. Not just in 2022 in totality, but across 5 months we've had 4 different chancellors, and in 3 months we've had 3 different prime ministers. So what we've seen this year is an awful lot of potential change that didn't happen, announcements that then got reversed, reversals of previous reversals, and we hope to make all of that a lot clearer this morning. And as Jeremy Hunt said last week, the government's priorities are stability, growth, and public services. So with that in mind, and I think that's a gear stick going in reverse. Lots of reversals, as I said. And I'll hand over to Claire in the first instance to talk through the personal tax changes that we heard last week.
Thank you, Nick. Good morning, everyone. So not quite the blockbuster autumn statement we were expecting, as a lot of the potential changes trailed in advance and went further than the announcements. But nevertheless, there's still significant changes that will affect us all. So in keeping with the Conservatives' manifesto commitment, the headline rates of income tax will not change. So with that in mind, the only thing that the Chancellor could really play around with was the thresholds and allowances. So we already knew that the personal allowance and the higher rate threshold would be frozen until 2026, and that's now been extended for a further 2 years until 2028 at 12,570 for the personal allowance and 50,270 higher rate threshold. So what does this mean? Well, if you currently don't pay any tax, you could be pulled into paying basic rate tax, and this could particularly affect pensioners who will benefit from the state pension triple lock increase this year. And similarly, in the current environment of very high inflation, we'll also see many taxpayers being pulled into the higher rate of tax. So in other words, as this is being commonly referred to, this is a stealth tax, because the effect of the fiscal drag will mean that more people will pay tax, perhaps without even realising it. So the announcement that I think has probably received the most amount of press is the reduction in the additional rate threshold from 150,000 to 125,140 from the 6th of April 2023. This number may seem oddly specific, but it's actually the limit at which the personal allowance is completely withdrawn. So we now have this sort of bizarre effect where if you're earning above 125,140, you pay 40% on earnings above 50,270. You then have an effective rate of tax of 60% of earnings between 100,000 and 125,140, and then 45% thereafter. So quite bizarre. So if you are already an additional rate taxpayer earning over £150,000 a year, you'll pay an extra £1,243 in tax a year. If your earnings are between the 125, 140 and 150, you'll be paying an extra 5% on earnings in excess of that threshold. But more importantly, you will also lose the benefits of your personal savings allowance if you're being dragged into that additional rate now. So this personal savings allowance is the tax-free allowance for savings income. So if you do have interest from a bank account or building society account, you will now have tax to pay on that income if you're a 45% taxpayer. So what can you do if you are being dragged into that 45% rate? Well, if you can accelerate any income into the current year or potentially delay any income tax reliefs to increase your income in this year, then you'll have more income tax at 40% rather than the 45% rate. And don't forget that if you are a higher rate or additional rate taxpayer, you can mitigate that by making pension contributions or gift aid donations, because the effect of doing that is that your basic rate tax bands and high rate tax bands are extended. So the 45% rate was introduced in 2010-11, and at that point it affected relatively few taxpayers, less than 250,000. And with the reduction in the threshold, we're now going to see over 1 million being pulled into this tax rate. So in this way, the Chancellor, he looked to land the burden of the tax rises on the higher earners, but in fact, freezing the thresholds will mean that everyone will be paying more tax. And in fact, higher earners will actually be slightly better off in the next tax year compared to the current tax year, due to the reversal of the 1.25% increase in national insurance, which applied from earlier this month. So the tax rate on dividends, they have stayed where they are. So if you recall, the 1.25% increase in the dividend rates was introduced to match the increase in the national insurance contribution rates, to ensure that those receiving dividend income were effectively contributing the same towards the health and social care. And despite the reversal, the increase in the national insurance, the dividend rates have stayed where they are. So we now have these quite obscure rates, which I always fail to remember: 8.75 basic rate taxpayers, 33.75 for high rate taxpayers, and 39.35 for additional rate taxpayers. But what did change was the dividend allowance. So this was introduced in 2016 at £5,000. It was then reduced to £2,000 in April 2018. And now we will see it halved again to £1,000 from next year, £500 from April 2024. So by 2024, the value of this allowance, has been or will be significantly eroded. So inevitably, this will mean that we will see many more people being required to file self-assessment returns. Again, I use the example of pensioners that might supplement their pension income with dividend income. And so if you are affected, you've got to be aware of your new obligations now. Because if you fail to register or fail to file a tax return on time, then there could be some quite significant penalties for doing so. So yeah, a word of warning, keep an eye on that level of dividend income. ISAs remain a tax-free wrapper, so dividend income received in a wrapper in the ISA will continue to be exempt, so you could consider holding some shares in an ISA. The national insurance contribution limits, again, frozen until April 2028, and the lower earnings or profits limit is now aligned with the personal allowance. So the rate at which, the limit at which you start to pay national insurance will be the same as for income tax, and these limits apply for employees and the self-employed. So there's a huge amount of speculation for the autumn statement, as there always is, about capital gains tax rates going up. And we certainly saw a few clients rushing transactions through, but there has been no changes to the rates, which will be a relief for many. So we have the standard rates of 10 and 20%. for basic, well, 10% for basic rate taxpayers, 20% for higher and additional rate taxpayers, to the extent that those gains fall within those tax bands, depending on your income. And the rates for capital gains on residential property are higher at 18% and 28%. There were no changes to business asset disposal relief. So for qualifying gains, the relief will be at 10%, sorry, the tax rate will be 10%, up to a lifetime limit of 1 million. So what did change was the annual exemption. So that's currently at 12,300 for the current year. That has been more than halved to £6,000 for next year and £3,000 for 24-25. So again, undoubtedly, this will bring more people within the scope of self-assessment, as they'll be required to report more disposals to HMRC. I mean, in reality, this measure will affect, I think, very few taxpayers, but those that are affected could have more capital gains tax to pay of up to 1,764 from next year, and up to £2,604 from 2025. So to the extent that you do have assets standing to gain, and you can crystallise those gains in the current tax year, that will maximise those exemptions at the current rates. Inheritance tax, no changes there, other than the limits being frozen until 2028. So we have the nil rate band that remains at 325,000, and the residence nil rate band at 175,000. And the limit at which the residence nil rate band begins to taper away will continue to be at 2 million. So this nil rate band, it's been at this level since 2009, and we've seen many more estates being dragged into the scope of inheritance tax with rising property prices. So, I mean, we can just expect this trend to continue, and the revenues inheritance tax take to increase year on year, which we are seeing. So you can plan for inheritance tax, and there are things you can do to mitigate your potential liability, such as gifting to the next generation, setting up trusts. So something you can think about doing in lifetime, particularly if we see a change in government, because it could all be change at that point. Stamp duty land tax. So the changes announced on the 23rd of September 2022 remained in place, but it will now only be temporary. So what were these changes? So we had an increase in the nil rate threshold from 125,000 to 250,000 for all purchases of residential property in England and Northern Ireland. And similarly, the threshold paid by first-time buyers increased to 405,000. And the maximum purchase price for first-time buyers relief has increased to 625,000. So this will now be a temporary reduction and will remain in place until the 31st of March 2025 to essentially support home buyers and the housing market. No change announced to multiple dwellings relief and the rates of stamp duty land tax that apply to mixed use transactions, despite the government consulting on this. So perhaps watch this space, changes coming there at some point. A further change related to property, so ATED, which is the annual tax on envelope dwellings. So that is the annual tax on corporate vehicles which hold high value UK residential property. So the annual chargeable amounts, which is the tax charge, will be uplifted by inflation from next year. So it will mean that if you are a company within this regime, you'll have a minimum of £4,150 to pay from next year. So essentially what this will do is prevent individuals that are UK resident but not domiciled in the UK from putting UK shares into a non-UK company and effectively taking those profits out of the UK tax net by claiming the remittance basis. So a relatively minor change there, but I think given the political vulnerability of the non-dom regime, again, might not be the end of the changes that we see here in advance of the general election in 2024. So that's the end of the personal tax section. I will just look at the questions. How can we download the transcript? We'll come back to you on that. I think Kirsten, our PD assistant, can help with that. UK citizens living overseas. So one of the questions here, how will UK citizens living overseas with the UK income from dividends be affected? Well, the allowances apply equally to non-UK residents, but dividend income received by non-UK residents is disregarded. So essentially the maximum tax you will pay on dividends is the tax deducted source, which is now nil. So there shouldn't necessarily be any change to your tax liability, but it does depend on your other sources of income, and you have to do a comparison between the disregarded income calculation and the normal calculation with the benefit of the personal allowance. So it's just a case of comparing those two calculations. And I'll hand over to Nick to talk about the corporate and business tax changes.
Okay, thanks, Claire. Well, we've had quite a seesaw in corporation tax rates, and that seesaw never happened. Early in this year, in the spring, Rishi Sunak, when he was the Chancellor, announced that the corporation tax rate of 19% that's been in place for around 5 years or so now was going to increase to 25% from April next year. That was then reversed when Kwasi Kwarteng was the Chancellor, and then reinstated by Jeremy Hunt. So what will happen from the 1st of April next year is that there'll be a 19% rate, which is the same as it has been for profits up to £50,000. And then if your profits are over £250,000, you'll pay a flat rate of 25%. And what that means is that for the profits between £50,000 and £250,000, there's essentially a marginal rate of 26.5%, so that there's a sliding scale to get you up to a flat 25% on all of your profits. So just be aware, if your profits are between £50,000 and £250,000, you're essentially paying a marginal rate of 26.5% on your taxable profits. There's been some quite significant changes to the benefits that are available from R&D tax relief being announced. There weren't significant changes announced to the operation of the scheme, but there were big changes announced to the benefit. So if you're within the large company scheme and you claim what's known as the RDEC, the Research and Development Expenditure Credit, the benefit you get, it goes up quite a lot. The way the RDEC works is to come through as a grant, and you have historically got 13 pence in the pound for every pound of expenditure. That has historically been taxed at 19%, so the 13% gets you a net position of about 10.5p in the pound. That's going up to 20%, and that itself will be taxed at the new corporation tax rate of 25%, so the net benefit of 15%, 15p in the pound. So it's going up, the benefit's going up by around 40%, from 10.5p in the pound to 15p in the pound. So quite a big increase in the benefit if you form part of the large company scheme. If you're an SME, where the government believes there's been a lot of fraud and aggressive use of the scheme, they're sort of taking a scythe to the benefit, sort of sledgehammer to crack a nut type thing, by reducing the benefit at a wholesale level. And it might be easier if Claire, if you go on to the next page to show what that will look like. So if you're a profit-making company and you're claiming R&D under the SME scheme, essentially the way the numbers work is that you get reduced from a benefit of 24.7% on a net basis to 21.5%. And the biggest reduction is for loss-making companies within the SME R&D scheme, where they're reducing from 33.35% net benefit to 18.6% net benefit, which is virtually halving the benefit. When you take into account that a lot of companies that are spending money on R&D in the early part of their business, that tends to be the time when they're making losses as well. So it's a really big reduction in the benefit for companies that are making losses. And what's in the detail, what the government said is that they're looking towards moving it to one overall scheme. So there's no difference between us. So ultimately, they're looking to have just one scheme covering all types of company. There'll be no large scheme. There'll be no SME scheme. And so the actual rates are getting a lot closer. The large company scheme, if you remember, I said was going to 15% net benefit, which is a lot closer now to the SME numbers as well. So we expect more to come over the coming months and years on R&D. Moving on to capital allowances, there's been in place a super deduction, which has allowed you a sort of 130% upfront tax deduction for every pound that you've spend on fixed assets, and that sort of 2-year sort of COVID relief comes to an end on the 31st of March 2023. But what the government has announced is that the annual investment allowance, which gives you 100% relief, will be permanently set at £1 million going forward. It's always been sort of temporary and subject to change and so on, but they have announced that will be permanent going forward. So as long as you're spending less than £1 million per year on your capital expenditure that qualifies for capital allowances, you'll still get 100% relief. So that's a relatively decent amount to spend for the vast majority of businesses who are spending. Some of the things to think about the change in rates, the increase from 19% to 25% it doesn't take effect until the 1st of April. So there are some things that you could consider doing to plan around that. If, for example, you've got a big one-off event coming between now and the end of March before the rate comes up, consider changing your year end. That might help with the rate of, say, a big capital gain within the company or something like that. If you do spend a lot of money on capital expenditure, more than £1 million a year, it might be worth thinking about accelerating that capital expenditure to make use of the super deduction before it comes to an end. And you may also want to think about accelerating your R&D expenditure, because those changes that I mentioned, the reductions in the benefit don't take effect until the 1st of April 2023 as well. So if you're looking to spend money on R&D and you've got the capacity to accelerate that for the better rates of benefit, you might want to think about doing that. We have a number of creative sector reliefs in the UK, and the government is looking at ways in which it might be able to simplify that, because we have 8 different reliefs covering all the areas that you can see there: film, animation, high-end TV, children's TV, video games, theatre, orchestra, and museums and galleries relief. The government said it's not doing anything for now on theatres, orchestras, and museums and galleries, but it does see the capacity for simplification of what it's classing as audio-visual reliefs, so film, animation, high-end TV, and children's television, and video games. And for 4 of those, the first 4, film, animation, and the 2 TV ones, it's considering consolidating those into one single scheme, but it's also considering what it might do to reform video games relief as well. And we don't really know whether that will end up in the schemes becoming more generous or less generous, but they do want to focus on what's known as the culturally British test, and a key part of those reliefs and a requirement conditions for businesses to be able to get relief for investment in those those areas. Moving on, banking surcharge. So for a while now, there's been an additional rate for banks. So historically, instead of paying 19%, there's been a banking surcharge rate of 8%, which has given them a combined corporation tax rate of 27%. Because of the increase to 25% of the standard rate, they are reducing the surcharge to 3%. So the bank's rate is effectively going up from 27% to 28%. So whilst most businesses are seeing their rate of corporation tax going up from 19% to 25%, banks are having a comparatively lower amount of increase from 27 to 28%. That is to do with ensuring that banks stay competitive and that the rates for banks isn't too high against international competition. Some other and this is where actually the big money is in from a business taxation point of view, the windfall taxes on energy companies. So there's been a in place now windfall tax or energy profits levy on oil and gas companies that was introduced earlier this year. That, when it was first announced, was designed to raise around £20 billion, but there's effectively been an increase to that, which will double the expected take into the exchequer from 20 to £40 billion. And that is to extend the energy profits levy through to March 2028, so another 5.5 years, and also to actually increase the levy by 10 percentage points from 25% to 35%. And what it will mean for those businesses that are affected by it, essentially the very big oil and gas companies, is that they will have an effective rate of corporation tax of 75% to pay through now to March 2028. So quite a significant increase. And we've already had some announcements from businesses like Shell that they're obviously remodeling projects and determining whether those will whether they'll go ahead with those given the increase in the rates. There is an investment allowance which effectively allows you to get tax relief for those who are then investing in infrastructure. I guess not dissimilarly to the annual investment allowance and the super deduction that the kind of broader range of corporates have. That investment allowance is reducing, so that overall the net cash available from that investment allowance is broadly the same as it was prior to the increase in the overall rate. But that is designed to, it's an overall temporary levy, so we're told through to the end of March. There's then an additional brand new levy or windfall tax being introduced, and this is the electricity generator levy. So those at the moment who are making what are described as extraordinary profits from the price of electricity at the moment, a levy has been introduced, and again this one will also run through to the 31st of March 2028 and will start on the 1st of January 2023. And for those companies that are making extraordinary levels of profits, they will have an effective corporation tax rate of 70%, 70% on the profits that they make. So again, quite a significant tax rate for those companies for the next 5.5 years. That is expected to bring in £14 billion of revenue into the government. So those are really the sort of big numbers within the business tax changes. I'll just mention a couple of other things as well. So the diverted profits tax, which is designed to counteract essentially contrived arrangements to avoid having a taxable presence in the UK. Those were hit with essentially with a 6% levy. and so instead of those profits being taxed at 19%, they were taxed at 25%. Again, that differential is being maintained, so the diverted profits tax is increasing from 25 to 31% to maintain that difference. The government did also announce that the sort of globally agreed changes to a sort of global minimum tax, which had been discussed at the United Nations level, OECD level, that the government would be legislating to implement that, and what that would mean. But from the end of next year, multinationals that are headquartered in the UK, if they have overseas subsidiaries and those overseas subsidiaries pay an effective rate of tax of below 15%, there will then be a top-up tax implemented onto those profits to ensure that overall a UK multinational that has over foreign trade and foreign businesses will pay at least at a minimum of 15% on all their global profit. And that is the changes to business taxation. So I just got, there's a few questions actually, so let me have a look at these. On the CT rates, our profits, PCTCT, so that's profits chargeable to corporation tax, and is it split if there are multiple companies in the group? So yes, when I talked earlier about the 50,000 and the 250,000 to work out whether you're paying tax at 19% or 25%, or whether you're in the zone of essentially paying a marginal rate of tax of 26.5%. Those limits are effectively reduced if you've got multiple companies in a group. So what I was talking about there as earlier applies to a single company, but yes, in the same way that's always been done historically, you have to take into account associated companies to reduce the limits. So the super deduction is to encourage. I mean, it's essentially pretty much all things that in the main that qualify for capital allowances, plant and machinery and fixtures and fittings and so on. They do have to be new. So nothing that's secondhand. It's designed to encourage investment into new assets, and yes, it would cover an office fit out as well. It's a personal question there as well, I think, if you want to pick up on it.
Which one? The
second one down.
Yeah, so we've had a question here. Corporation tax is paid on the company profits. Do we have to pay personal tax on the dividend taken from the company? The answer is yes. There is that element of double taxation when you take profits out of the company. And shortly, as I move on through the presentation, we can look at the effective rate of tax when you do that. So we'll come on to that.
There are quite a few questions coming through, and we won't have time to get through them all, but what we'll do is we'll make sure that with the transcript, all the questions are answered in writing. And for those of you that don't get the questions answered, we will make sure those get covered in what gets sent out afterwards. I'm just going to touch very briefly on VAT. There was very little announcement on VAT, but they did announce that the VAT registration thresholds would remain the same. Those registration thresholds of 85,000 and deregistration of 83 have been around since 2017, and it's been confirmed that they'll still stay around until at least March 2026. So that's essentially bringing more companies in over the course of 10 years, given the registration threshold has not changed. But they were keen to point out that our registration thresholds are still twice as high as overall EU and OECD averages. The other point, just on sort of indirect taxes, not really VAT, but the government had been consulting on an online sales tax, which was essentially to deal with a perceived lack of competition for online businesses, where they're benefiting from the fact that they've not had to pay essentially business rates on the high street because they haven't got bricks and mortar out of which companies that are businesses that sit on the high street out of a retail operation would have to suffer. But essentially the government's decided that an online sales tax for businesses to operate there is far too complicated, and it would distort competition in the wrong way. So we don't have the details of all the details of why they've decided to go against it, but they are going to look at different ways of dealing with that issue. And I'll pass over to Claire to deal with the taxes section.
Okay, so we'll just have a whistle-stop tour through the employment tax changes. So with the increase in the corporation tax rate and the high dividend tax rates, for business owners that typically pay themselves a small salary and take the rest of their income by dividends, it may now be worth reassessing whether that's still the most tax efficient way to extract profits from the business. So you can see on this example, so this example assumes a salary or a dividend of 100,000, and you can see that there is actually a small saving taking a salary now compared to a dividend due to these increased dividend rates. So to the extent that you can accelerate some income perhaps into the current year, dividend income, you would be looking at 50.87% effective rate for an additional rate taxpayer, or 46.34 for a higher rate taxpayer, compared to these 55 or 51% rates from next year. So the level at which employers will start to pay employers national insurance contributions on employee earnings will be frozen at 9,100 until 2028. So this announcement is forecast to raise one of the largest amounts for the Treasury, expected to bring in an extra 25 billion over the next 5 years. So as a result, I mean, we could see this have an indirect impact on wages, as the cost of employing people will rise as salaries increase. However, the employment allowance, which provides smaller businesses with a reduction in the employer's national insurance contributions bill, that will remain at £5,000. So whilst we'll see this threshold frozen, the employment allowance will mean that around 40% of businesses won't have an employer's national insurance bill. So the off-payroll working rules, commonly known as IR35, after they were briefly repealed, much to the surprise of everyone, we are now back to where we were. So these rules were introduced in 2017 for the public sector and 2021 for medium and large size organisations in the private sector. So organisations that are subject to the rules are responsible for determining the employment status of contractors that provide their services through personal service companies. And if they determine that those contractors are employees, then they have to ensure that they account for pay-as-you-earn and national insurance in the same way that they do for their employees. So back to where we were in terms of those rules. So there were a number of announcements related to company cars. So we are seeing the benefit in kind rates for electric and ultra low emission cars increasing. So whilst there remains an incentive for the provision of electric and ultra low emission cars, we do now have some certainty in terms of the rates that will apply until 2028. So for electric and ultra low emission cars, the rates will increase by 1% each year for the next 3 years, up to a maximum 5% for electric cars and 21% for ultra low emission cars. And we're also going to have road tax payable on these vehicles from April 2025 in the same way that we do for petrol and diesel vehicles. For all of the vehicles, the benefit in kind rates again will be increased up to a maximum of 37%, which will then be fixed in 2026 and 2027, 28. So those with electric cars or those considering purchasing or leasing electric cars through a company, you may wish to reassess the tax costs of doing so. But nevertheless, the tax costs will be relatively low compared to petrol and diesel vehicles. So, this will likely still remain an attractive employment benefit, particularly if it's provided through salary sacrifice arrangements. And finally, so whilst most company cars are a common taxable benefit, van benefit you don't tend to see so much because no taxable benefit arises if it's provided for business use with a small amount of private use. But nevertheless, where you have a van benefit charge, that will increase in line with inflation from next year, as will the fuel benefit charges for cars and vans. Fuel benefit charge being the value of the benefit if an employer provides an employee with fuel use. Okay, so what companies qualify as small companies? 35 rules. I would need to come back and check that on this. No, we'll come back and check and confirm that point with you. Okay, so any more questions?
Well,
10:45 bang on.
yeah, so almost like it was planned that way. But thank you very much for listening. As I said, the slides together with responses to questions will be distributed. You can also see a full summary of the budget announcements on our website, which is on the next page, Claire, which is, if you don't know already, www.moreks.co.uk. There is also a short 5 or 6 minute video with all of this in bite size as well. So thank you very much, and we will see you again when we have yet another budget. And thank you very much for listening.
Thank you.
Bye.
Bye.